Hi everyone. I trust all you are doing well. In today's session, we will start new model that is startup valuation. Now, before I start this model, I want that you should understand that what is startup valuation and what is the importance of this model, right? So first you should have idea that what is startup. So startup basically means the business which has been recently started or the business which is in early stage. That is what a startup. I can take here a very simple example of Zomato Limited, right? So Zomato Limited got started in year 2008 by Dipinder Goyal. So Dipinder Goyal, he is the CEO of Zomato Limited. Now, when Zomato Limited got started, right, at initial stage, what Dipinder Goyal has done, he has introduced funds from his pocket. Now, later on, he realized that if he wants to expand the business, so what he need here, he need funds from the investors, right? He was not having that much fund that he can invest into the business and he can expand that particular business. So he was knowing this thing that if he wants to expand his business and if he wants to continue this business for a longer run, so he needs to take the funds from institutions from HNI, and then he will be able to survive in the market, right? Now, you just let me know if somebody wants to raise the funds from HNIs or institutions or from any kind of investor. What is the first requirement of fundraising? The very first requirement of fundraising is that you should know the valuation of your business, right? You should be aware about the valuation of your business. And what is the total valuation of your business? If you know the valuation of business, then what you can do, you can raise money from the market. Now, let's suppose if I again take the example of Zomato Limited. Here, what Dipinder Goyal has done, he went to the several investors and he has raised funds from the investors. Now, let's suppose if he do not know the value of his business, is it possible for him to sell his equity to the investors or HNIs? No, he won't be able to sell his equity to the HNIs and any other investors. Why? Because we know that 100% is the maximum equity of any business, right? So equity can be 100%, not more than 100% into any business. Now, if he wants to sell, let's suppose 10% equity to the investors. So definitely what he will do for 10% equity, he will charge some amount from the investors. Now, if he do not know the value of business or if he do not know the correct value of business, so how come he will be able to raise the funds, right? So here to find out the value of startup business or early businesses, what we need to do here, we need to prepare the financial model for startups, right? Now, in case of startups, we have to put more efforts to prepare the model. Why we need to put more efforts to prepare the model? Because in case of startups, you won't find the much historical data. So what we have to do, we have to compute each and everything to find out the value of business. Now, what we will do here, we will start with this model. We will read the assumptions, we will read about the company, and then automatically you will get more and more clarity about this concept, that how we can prepare the startup valuation model. So let's read here, some assumptions are given. Here you can see basic information related to the business is given. So Contact is a newly established company that produces laptops and computer. So there is a company who produces laptops and computer. In order to dilute their equity and raise money from the market, owners desires to raise money from the investor. Now here the owner, the CEO of business wants to raise money from the investors. To that end, they need to ascertain the overall valuation of company. So if they want to raise money from the market, so they should have the idea, they should know the valuation of the company. Contact has projected the financials using assumption based on prior experience and market research. So Contact has presented some assumptions and these assumptions are computed on the basis of their past experience and they have done some market research also, right? What they have done some market research also on the basis of these research and experience, they have prepared some assumptions, right? Now, if you read the next line, what next line says here, please assist Contact in determining the total worth of the company. Now, here, what you have to do, you have to assess to the company, right, to find out their total valuation. This is what we have to compute here. So now we will help contact to find out their valuation with the help of the assumptions, right, which has been provided by content. Now here, if you see, the whole assumption is given in one sheet. What we have to do, we have to use these assumptions, and with the help of these assumptions, we have to fill these sheets, right? Or we can say that we have to, prepare the financial statement of the company, right, with the help of given information. And then at the end, what we will do, we will find out the valuation of business, right? So here we will prepare whole model, and what you have to do, you have to focus a lot, and I can give you the assurance that you will understand each and everything. The thing is that you have to focus a lot. Now, if you see here, so assumption is given related to the unit sales, right? So here, if you see what assumption company has made, that in year 2024, company will be able to sell 10,000 units, right? Then in year 2025, company will be able to sell 12,000 units. Then in year 2026, 15,000 and 17,000 units. So here information is given related to the units. So what I will do here, I will write down units after the numbers. Yeah. So here I've written the units. So here we can see that company will be able to sell 10,000, 12,000, 15,000, and 20,000 units. Now, if you further see, so you will be getting more idea here. Here, price per unit is given, right? At what price company will be able to sell these products in the market. So here, company charges $1,000 for one laptop. And you can see that there is decline in the cost. So company is pretty sure that once the sales of company will increase, right? So automatically their cost will decline due to the benefit of economies, right? Their cost will decline. So here price per unit is given, which is $1,000, $960, $920, and $900. After that, if you see here, composition of sales is given here, right? So composition of sales means here that what percentage of credit sales company will perform and how much cash sales company will perform. So here, if you see cash sales is given, so cash sales is going to be the 60% of total sales. So once you will compute the total sales here, right? From that total sales, the cash sales would be 60%. And here you can see credit sales would be 40%, right? Here you can see that the credit sales would be 40%. After that, you can see here days receivable and days per year is given. So days receivable is given, that is 45 days. What does it mean? That you sell your product on credit basis for 45 days. That you sell your product on credit basis for 45 days. So today, if you have sold some goods, so after 45 days, your customer will return you the money. And company operates for 360 days in a year. Then here you can see information related to COGS is given, that is cost of goods sold. So here what information is given related to the COGS? Here they have provided the information related to the components which are used to manufacture the laptop. So company require monitor screen and monitor casing, and company do assembly work also, right? So here for monitor screen, company spends $75 for an unit. Like company spends $75 for an unit. So if company manufactures 10,000 units. So company will spend somewhere around 75 into 10,000 if you will do. So total cost towards monitor casing, monitor screen in first year is going to be $750,000, right? So this is the information given related to per unit, right? 75 per unit. Now, here information related to monitor casing is given, assembly work is given. Once you will do the total of these line items, so here you will be able to compute the total COGS, right? We have to multiply this with number of units and we will be able to compute the COGS here. Then if you see here, information is given related to inventory and purchase worksheet. So inventory input is given here, that days inventory and days payable is given. So days inventory means that how long company holds the inventory, right? How long company holds the inventory. So here days inventory is given, that is 60 days, 60 days, 60 days. What does it mean? That company holds inventory for 60 days. So if you're not able to connect with me, I will come to the operating cycle point, right? And we will discuss about the operating cycle in detail. So you will be getting more clarity about these concepts. I've already discussed the operating cycle in my previous lectures, but do not worry, I will revise it for you. Days payable is given 90 days. It means when you buy goods, right, from customer, what you do here, you make them payment after 90 days. It means your supplier provides you credit for 90 days. Now, here information related to headcount is given. Headcount means here number of employees company has recruited during the year. So here information related to CEO is given. So company has hired one CEO. CEO, they are indirect owners, so we can't say hired. So there is one CEO in the business. The information related to CFO is given. So there is only one CFO. Engineer is one. VP sales and marketing is one here. VP business development is zero in first year. Then you can see salesperson. There are five salesperson. Hardware engineer is two. Controller and accountant is one here. Administrative assessment assistant is here three. So here you can see total number of employees which are hired in first year is 15. Then you can see gradually there is increase in the number of employees. And after this, you can see here the annual salary of employees are given here. Right? Annual salary of employees given. So how much salary company pays to the CEO? Company pays $200,000 to the CEO. How much salary is paid to the CFO? $175,000 is paid to the CFO. Then to VP and engineer, $175,000 is paid. Then this is how you can see the salary information is given. And apart from this, here appraisal rate is given. How much appraisal company gives to their employees? Here 12% appraisal is given. That is per annum. So every year what company do, company pays, gives appraisal of 12% per annum. Then after that, you can see here information related to operating expenses given. So here, first line item which is given under operating expense line item is miscellaneous expense, right? So how much company spends towards the miscellaneous expenditure? That is 3% of sales. So company spends 3% of sales towards miscellaneous expenditure. Now here you can see R&D expenses given. So what percentage of amount company spends towards R&D? So here you can see company spends 7% for first 2 years and 8% for next 2 years towards R&D expense. Then here you can see rent expenses given. So rent expense per square foot is given, that is $25. So here company has captured 4,000 square feet. So per square feet company pays rent, that is $25, and the total area which has been captured by company is 4,000 square feet. So how much total rent company pays here? Company pays total rent, that is $100,000. Here what we have done, we have multiplied these values and we got the answer that company pays $100,000 each year. Then here tax rate is given, right? Here you can see tax rate is given. Tax rate is 35% for each year. Now here if you see information related to capital expenditure is given, right? Here we can see the information related to capital expenditure is given. Equipment purchase, furniture purchase, and fixture purchase is given. So what company do? Company buys this amount of furniture each year. What I will do here, I will make small changes here. Instead of 30,000, I will take here 10,000 and uh, 3 lakh, 1 lakh, and 5 lakh. Right here, I will make the changes. So what company do? Company invest somewhere around 9 lakh, right, in fixed assets, 4 lakh 50,000 in acquisition of fixed assets, and I will drag these values. So here I have changed the value, and here now it is 450,000. What company to company acquires asset worth $450,000 each year because company is in expansion mode and company spends somewhere around $450,000 each year for the acquisition of assets. Now here you can see percentage of purchase paid for in purchase period, right? So here how much company pays for the capital assets? Company pays 100%, right? Company pays 100% towards the acquisition of capital asset, right? Then here you can see depreciation input is given. Here you can see depreciation input is given. So here they have not provided information related to the percentage of depreciation, right? Nowhere if you see it is given that what percentage of depreciation here we have to charge to find out the final value of assets. Here they have provided the information related to the life of asset. So equipment life is 5 years, then furniture life is 5 years, and fixture life is 4 years, right? Then after this, you can see your information related to cash worksheet is given. So we will do discussion on cash worksheet later on. Right now, what I will do, I will start with the first sheet, that is sales and collection. Now, is it possible for us to find out the sales and collection? Yeah, definitely what we can do here, we can find out the value of sales and collection here. So let's see here. Information related to unit sales and price budget is given. Here, what number of units company will sell in coming years? So here from assumption, what I will do, I will copy these number of units. You can see. So company will sell 10,000 units in first year, then 12,000, then 15, then 20. And after that, if you see here, price per unit is given. So I will fetch price per unit from the assumption sheet, and this is the price per unit. Now, if I want to find out the total sales, if I want to find out here the total sales, so what I will do, I will multiply this with 1000, and here we can see the total sales. Right here, you can see this much is going to be the total sales of the company. So you can see in first year, company will be able to achieve 10 million or 100 lakh sales. Right, company will be able to achieve 1 crore sales. Right, so sales would be of $1 crore. Here, company will be able to achieve sales of how much? Company will be able to achieve sales of 115 lakh. Right, company will be able to achieve sales of 115 lakh 20,000 in next year. Right. Then here we can see how much sales company will be able to achieve in next year. Company will be able to achieve sales of 138 lakh. Right. So this is how you can see the sales of company will increase each year. Right. Now here we know the composition of sales. So here, if you see, the total sales is 1 crore, 1 crore 15 lakh, 1 crore 28 lakh, 1 crore 80 lakh. If I want to find out the balance of cash sales and credit sales, we already know the proportion here that out of total sales, cash sales would be of 60%. The cash sales proportion would be 60%, and credit sales proportion would be of 40%. So if I want to calculate the cash sales during the year, so we will take 1 crore and we will multiply this with 60%. Right? We will multiply this with 60%. So once you will multiply this with 60%, so here you will be able to find out the cash sales value. If I want to find out the credit sales, so here what I will do, I will take 1 crore and I will multiply this with 40%. Right? I will multiply this with 40%. So here you can see this is going to be the cash sale and credit sale for the year. I think you understood, right? What amount of cash sales and credit sales would be performed here. So what we can do here, we can do the total. And you can see this is the total of sales amount, right? This is the total of sales amount. Now, what we have to do here, we have to prepare the collection budget. Now, if we want to understand the collection budget, so what we need to do first, we need to check the assumption which is given here. And we should have the idea of operating cycle, right? We should have the understanding of operating cycle, that what actually is operating cycle. So let's begin with the operating cycle, right? And then we will discuss more about it. Now, what is operating cycle, right? Operating cycle means how much time it takes business to convert their raw material into cash, right? To convert their raw material into cash. Now, let's suppose what you have done, you have started your business on 1st April 2024, right? Now, here on 1st April itself, you have purchased raw material from the supplier, right? There is a supplier who has supplied raw material, right? Who has supplied raw material to you. Now, what you have done, you have acquired this raw material from the supplier. And your suppliers gives you the credit for, let's suppose, 30 days, right? Your supplier gives you the credit for, let's suppose, 30 days. So when you have to make the payment to the supplier, you have to make the payment to the supplier after 30 days, right? So if you will count 30 days from 1st April, so here you have to make the payment on 1st May to the supplier, right? When you have to make the payment to the supplier on 1st May, you have to make the payment here. Now, what you have done, you have started the business, and on day one itself, you have started the manufacturing process, right? Now here it takes, somewhere around 60 days to manufacture the product. So you have purchased raw material, then you kept raw material into go down for some days. After that, you have started manufacturing process, right? After that, you have started manufacturing process, and here you were able to manufacture the finished goods, right? Here you were able to manufacture the finished goods, and here you can see this is your raw material time, right? You kept the raw material in go down, and here this is your work in progress time. Now, here, once you manufacture the goods, in 10 days, you are able to sell these goods to your customer, right? It takes 10 days time to sell your goods to the customer, right? And now what your customer do? Customer pays you this amount after 45 days. You receive amount from customer after 45 days, right? So if I ask you that what is the total duration of conversion period, right? Conversion period means that how much time it takes to convert your raw material into cash, right? So if I ask you to count the time, so what you have done, you have when you have purchased raw material, you kept raw material into go down for, let's say, 5 days, right? You kept raw material into go down for 5 days, right? So here I will write down 5 days. You kept raw material to go down for 5 days. After that, you have brought these raw materials into manufacturing process, and it took 60 days time. Work in progress means that you have started the manufacturing activity, and it took 60 days time to manufacture the product. After that, what you have done here, you kept finished goods for 10 days in your godown because it takes 10 days now to dispatch or sell your finished goods to the customer. And your customer, which is your debtor right now, will pay you cash after 45 days. Will pay you cash after 45 days. So can we say that your funds were blocked for these days, right? Your funds were blocked for these days. So here you can see how long your funds were blocked. 70, then 50. It is 120 days, right? If you will do the total of these four items. So here you will get that your funds were blocked for 120 days, right? Your funds were blocked for 120 days, right? This is known as operating cycle. Now, what is the meaning of operating cycle? Operating cycle means that how much time it took to convert your raw material into cash. So the time which will take to convert your raw material into cash, for that period, your funds will be blocked, right? Your funds will be blocked in raw material, in work in progress, in finished goods, then in debtors. So your funds are blocked for 120 days. Now, here we have seen that supplier has supplied you goods on credit basis and you have received 30 days credit from supplier. You have received 30 days credit from supplier. So here, can we calculate the net operating cycle? So here, if I want to calculate the net operating cycle, so the formula would be here, operating cycle, that is of 120 days, right now we have calculated, minus creditor days, right? Minus creditor days. We have to subtract here the creditor days. So creditor has provided you 30 days credit, right? Creditor has provided you 30 days credit. So what is going to be your net operating cycle in this case? Your net operating cycle is going to be 90 days. Now, what is the purpose? Why I have discussed this concept? Because here in case we have seen that debtor days are given, right? Receivable or debtor days are given here. Now, if receivable or debtor days is given in the question, so what does it means? It means that your funds get blocked with the customer for 45 days because you provide credit of 45 days to your customer. When you provide credit of 45 days to your customer. Now, how company has calculated this 45 days? How company has calculated this 45 days, right? Here there is a formula to calculate the 45 days. The very first formula which we calculate to calculate these 45 days or days of debtors, here first we calculate, debtor turnover ratio. We calculate receivable or debtor turnover ratio. Both are same, right? Debtor turnover ratio. Now, what is the meaning of receivable or debtor turnover ratio? Let me write down the formula and then you will be able to understand. So your formula for receivable turnover or debtor turnover ratio is turnover turnover slash sales, right? Divided by average debtors, divided by average debtors, right? So here it gives you the idea, right? That what is the proportion of debtor as compared to the sales, or how many times you are able to convert your debtors into cash. This is what debtor turnover ratio talks about, right? Debtor turnover ratio means how many times you are able to convert your debtors into cash, right? Let's take an example that company has performed sales of $100 million. Company has performed sales of $100 million, right? And at the year, company found that the average debtor value. How you will calculate the average debtor value? You will take the 2-year financial statement, right? Let's suppose your 2-year financial statement is given for year 2020 and 21. And here the debtor value for 2020 is, let's say 40, and here debtor value is 50 million. So if I ask you to calculate the average, so I will calculate the average here. To calculate the average, you will take 40, you will add 50 here, and you will divide this with 2. So here you will get 45 million. This is going to be the average debtor here, right? So this is how we calculate the average debtor. Let's suppose here average debtor is 20 million. Right here average debtor is 20 million. So if you want to calculate the receivable turnover ratio, so here formula is going to be sales divided by average debtor, which is 20 million, and here you will get the answer, which is 5 times, right? It means on an average, you convert your debtor into cash for 5 times in a year. Right, for 5 times in a year, what do? You convert your debtors, or your average debtor is 20 million out of total sales. Right, your average debtor is 20 million. So here we can say that your average debtor is 20% of total sales. Your average debtor is 20% of total sales. Can we say that your average debtor value is 20% of total sales? Yeah. Sales is 100 million and debtor value is 20%. So it is 20% of sales. Now, if I want to find out here the debtor days, right? If I want to find out the debtor days here, so what I can do here, I can simply, you know, take a formula. I can simply take a formula here. So if I want to calculate the debtor days, so let's see what is going to be the formula here in this case. Here to calculate the debtor days, we have to use the formula that is going to be 365 divided by receivable turnover ratio. So here you can see uh, 365 days are in a year, and we know the receivable turnover ratio, which is 5 times. So if I divide 365 with 5, right? If I divide 365 with 5, so what result we will get here? Let me calculate this with the help of calculator. 365 divided by 5 I do. So that is going to be 73 days. It means your funds are blocked with debtors for 73 days. Debtors makes payment in 73 days. Similarly, what you can do, you can calculate the values for inventory days. If you want to calculate the inventory days here. So in this case, what you have to do, you have to follow the same approach, right? You have to follow the same approach. First, you have to calculate the inventory turnover ratio. First, what you have to do here, you have to calculate the inventory turnover ratio. Now, how you will compute the inventory turnover ratio here? Formula for inventory turnover ratio is going to be here COGS, right? We do not take sales here. Like in numerator, we do not take sales because inventory is very much correlated with COGS. In COGS, what we do, we record the cost of inventory. So let's suppose if sales and COGS both are given, so we will take care of COGS, right? These are all concepts I have discussed in ratios, I have discussed in working capital chapter also, right? But I'm revising it so you should be able to understand. And here, average creditor value we have to take, right? We have to take an average creditor value, right? So here we can see let's suppose the COGS is of $80 million, right? And here we can say that average creditor value is here 10 million, right? So if I ask you to calculate the inventory turnover ratio, so here, no, it should be average inventory. I'm sorry, here I have taken creditors. It should be average inventory. So here we have to take average inventory, right? And here also what we have to do, we have to take average inventory. So if I take 80 million and divide this with 10 million, so here we will get 8 times. Right here we will get the answer that is 8 times. Right. So here if I want to calculate the inventory days, so same formula we will apply. It what inventory days means that how long you block your funds, right? Inventory days means how long you block your funds. Now, if you want to calculate the inventory days, so what you will do here, you will take 365 and you will divide this with 8 times. Like what is going to be the formula here? Formula is going to be the 365 divided by inventory turnover ratio. This is going to be the formula. So here we can calculate the inventory days. It is going to be 365 divided by 8. That is going to be 45 days. So you block your funds into inventory for 45 days. Similarly, you can apply this in case of creditor also, and formula would be same. So the simple thing which you have to remember is that these ratios tells you that how long your funds get blocked into debtors, into inventory, and into other process, right? Due to which your funds get blocked. So usually your funds get blocked into inventory and debtors, right? So I think you got the idea what this point is trying to explain you. Now, if you will see the assumptions, you will get more clarity. Now, what this assumption says, days receivable is given 45 days. It means your funds get blocked for 45 days, or this can be the average debtor value. So if there are 360 days, right? So your funds get blocked for 45 days. Out of total 360 days sales, your average funds get blocked for 45 days. So here we can see that total sales is given. Right here we can see the total sales is given. Right, total sales is given. How much here it is? 1 crore. Right, total sales is given here. How much it is? It is 1 crore. Here, what company has done? Company has performed total sales of 1 crore. Right, and how many days company has performed this total sales? Company has performed this total sales in 360 days. Company has performed this total sales in 360 days. I'm talking about first year sales. So company has performed 100 lakh sales or 1 crore sales in 360 days, right? Now, debtor days is given, that is 45 days. It means out of total sales, 45 days funds are blocked, right? 45 days funds are blocked here. So, is it possible for you to take out 45 days fund to find out the debtor value, right? So, simply what I will do here to calculate the 45 days sales, I will multiply this with 45 and I will divide this whole value with 360, right? And this is how what we can do. We can calculate the debtor days, right? So I think you understood the process. The process is very simple. So if I want to find out the credit sales, right? So what I will do, I will follow this approach. Now here, what we have to do, we have to calculate the cash collected from the customer's budget, right? Now here, first we have to record the cash sales for this period. What amount of cash sales has been performed by the company? So here we know that cash sales is 60% of total sales, and we have already calculated here the cash sales value. So here you can see this is going to be the cash sales value, right? Here you can see this is going to be the cash sales value. Credit sales collected, right? Now we have to understand that what amount of credit sales company has performed and what amount has been collected, right? Now here you have to understand that the credit sales which company has performed is 40%, right? The credit sales which company has performed is 40%. How much company will be able to recover from this? Or is it possible for you to find out the debtor value from this credit sales? Would you be able to find out the debtor value from this credit sales? So this is the total sales which has been performed during the year. Right here, what we have to do, here I have taken total sales, but we have to take the credit sales here. You have to remember this thing. I forgot to mention this thing that whenever we calculate debtor turnover ratio, here we have to take the credit sales. What we have to do here, we have to take the credit sales, right? We do not have to take the total sales, right? So you have to take the credit sales because debtors arise when you perform the credit sales, right? So here, if I want to calculate the credit sales collected during the year. So first, what we have to do, we have to find out the debtor value. Right? First, what we have to do here, we have to find out the debtor value. Now, would you be able to find out the debtor value? So during the year, what company has done? Company has performed credit sales of 40 lakh. Now, if I want to find out the debtor value, so here you can see account receivable budget is given. It means debtor schedule is given here. Beginning account receivable balance. Beginning means opening balance. So recently business has been started. So obviously there will be no opening balance. You have to understand that if this is the first year of business, so we can say that there will be no opening balance. So here opening balance is going to be zero. Now, during the year, if you see, company has performed credit sales of 40 lakh here. Right? Company has performed credit sales of 40 lakh here. So, would you be able to find out the debtors which are not realized yet? Would you be able to find out the debtors which are not realized yet? Right here, there is a credit sales of 40 lakh during the year. So, it doesn't mean that whole 40 lakh you have not realized during the year. Whole 40 lakh you have not realized during the year. Right here, if credit sales is of 40 lakh, so out of this 40 lakh, some amount will be unrealized amount and some amount will be realized amount. So this sales has been performed in 360 days, right? This sales has been performed in 360 days, right? And we know that here debtor days are given, right? We know here debtor days are given, which are 45 days, right? Which are 45 days. So would you be able to calculate the debtor value here? So what is going to be the debtor value? Here, I will take 40 lakh and I will multiply this with 45 and I will divide this with 360 because this 40 lakh sales has been performed in 360 days, right? And out of 360 days, 45 days sales is not recovered. Why? Because we provide credit period for 45 days, right? So which the goods which we have sold at the end of the year, and that amount will be recovered in next year, right? That amount will get recovered in next year. So you have to understand here that out of total 40 lakh sales, what amount will get recovered in next year? It is going to be 45 divided by 360. So we will multiply 40 lakh with 45 and we will divide this with 360. So here you will recover this amount next year, that is 500,000 or 5 lakh. So balance amount obviously you will realize in this year itself, right? Balance amount you will realize in this year itself. So 35 lakh you will realize in this year itself. 35 lakh you will realize in this year itself. So if I ask you to tell me that what credit sales has been collected. So first we need to find out the addition to the account receivable. Listen to me very carefully. Here I will write down the formula for you. Credit sales multiplied with debtor days, right? Multiply with debtor days and divided by 360, right? Divided by 360. So here you will be able to find out the value of debtor which exists during the year, right? So here, if I want to find out the value of debtor, what I will do here, I will take 40 lakh. This is the credit sales, and I will multiply this with the debtor days, which is given here 45, and I will divide this with the 360, right? So here you can see we will get the value, which is 5 lakh, and we can drag this to the subsequent year. So automatically it will take the current year credit sales, right? And we will be able to find out the credit sales which has been performed during the year, right? Now, in first year, you have performed this much credit sales, and this amount you will recover in next year, right? This amount you will recover in next year, right? So we will subtract this amount here, right? We will subtract. So here in first year, you won't realize any amount. So zero subtraction we have to do. And what is going to be the ending account receivable balance here? The ending account receivable balance is going to be 5 lakh here, right? This is going to be the ending account receivable balance. Now, cash collected, right? How much cash has been collected? So the credit sales is of 40 lakh. Now, account receivable balance is 5 lakh. It means out of 40 lakh, you have not realized 5 lakh, right? But remaining 35 lakh you have realized. So I will calculate this value. It is going to be 40 lakh minus 5 lakh. Like the simple answer is going to be 40 lakh minus 5 lakh. So here, how much you have realized? You have realized 25 lakh. Here, how much you have realized? You have realized 35 lakh. So what is going to be the total collection during the year? Total collection is of 95 lakh, right? So out of 100 lakh sales, you have realized 95 lakh, and 5 lakh you will realize in next year. Now, if I talk about the next year, so here, this is the closing balance, right? This is the closing balance of debtor. You can see this is the closing balance of debtor. Now, this closing balance will become opening balance. Yeah, obviously, this closing balance will become opening balance. And I will drag this value here. So automatically, it will pick the closing balance of previous year, which will become the opening balance, right? Now, here, if I talk about the addition to the account receivable. So you have performed credit sales of 46 lakh during the year, right? Out of that, 45 days sales is outstanding, right? It means here the total credit sales is of 46 lakh, and you will be able to realize only you were not able to realize 5 lakh 76,000, and balance amount you have realized, right? So you have to understand this, that whatever balance amount you have not realized, right, you have to subtract that from the credit sales, and you will be able to get the amount which you have realized. Now you have to understand here that during second year, that is 225, right? That is 2025, you have realized this 5 lakh. And apart from this 5 lakh, you will realize, the difference between credit sales and account receivable for this year, right? So here you have to see that account receivable balance for this year is going to be 576 lakh. Now here what we have to do, we have to subtract from the account receivable. How much we have realized? Here, subtraction from account receivable means the amount which we have realized from last year's sales, right? So realization from last year debtor, right? Realization from last year debtor, right? So how much you have realized from the last year debtor here? You can see you have realized 5 lakh, right? So here I will write down 5 lakh, right? Here I will write down minus 5 lakh. This amount you will realize in this year. So I will write down here minus 5 lakh, and let's do the total here, right? Let's do the total here. So this is going to be the total. This is going to be the ending account receivable balance. So here, how much you will realize in this year? First of all, you will realize this amount, that is 5 lakh, right? First of all, you will realize this amount, that is 5 lakh. Then plus, what you have to do, you have to add this credit sales. So there is a credit sales of 46 lakh 8,000 during the year, and you were not able to realize 5 lakh 76,000. You are not able to realize 5 lakh 76,000. So you will subtract this amount, then press enter here. So during the year, what you have done, you have realized 45 lakh 32,000, right? How I have calculated this, again, I will repeat it for you. Listen to me very carefully. Previous year credit sales was of 5 lakh. This amount you will realize this year. Yeah, you will realize this year. Then you have sold, goods of 46 lakh 8,000 during the year on credit. Now this sales has been performed in 360 days, but we know that average debtor balance is 45 days here. So out of this total sales, 45 days sales has not been recovered. And that amount is 5,76,000. So here what I've done, I have taken this 5 lakh because we have realized this 5 lakh, right? Then we have added this total credit sales and we have subtracted the amount which is not realized, that is 5,76,000. Right? So here we will press enter. So you can see credit sales which has been collected is 45,22,000. Now what we will do here, we will do the total. So here once you will do the total, so you will find that total amount which has been collected during the year is 114 lakh 44,000. Now here next we can see, so what amount you will realize in this year? So obviously you will realize this 576,000, which is the opening balance. So I can drag these values here, right? And I will drag these values here also. So automatically we will get the answer for subsequent years, right? So if you're not able to understand, I will suggest you go and watch this part again, right? So automatically you will get the idea how this has been calculated. You know? So I will definitely show this sheet with you so you can go through with this sheet also. But my suggestion is do first by your own, right? Then you can review the sheet. So here you can see again, I will do the same step for third year. So you will be getting more idea. So previous year outstanding balance was 576,000, which you will realize in this year, which you will realize in this year. How we have calculated 6,90,000. So credit sales is of 55, 5 lakh 20,000, right? We have multiplied this with 45. We have multiplied this with 45. In assumption, we have seen it was 45 given, and we have divided this with 360 days. So out of total credit sales, right, this much amount has not been realized. This much amount has not been realized, right? So here to find out the credit sales collected, what we have done, we have taken the amount which has been realized from previous year, that is 5,76,000. Then here what we have done, we have added total credit sales and we have subtracted the closing debtor balance. So this is how we have calculated the cash collected from credit sales. So I think you understood what we have discussed till now. Remaining concepts, right, I will discuss in next video. Thanks a lot for watching this video. Thanks a lot. Thank you.